I think markets don't correct in and of themselves because suddenly they wake up one day and say, Google's too highly valued.
Yes.
You need to see, as I said, goes back to my earlier report, you need to see some stumbles on the earnings front and some, competitive threat emerging for one or more of those companies. And at the moment, it's not happening.
Hello everyone, David O'Reilly here from Northeast, and once again, I'm here with David Bassanese from BetaShares. Thank you so much for your time today.
Thanks for being here, mate.
Well, we've got a couple of things to talk about today. Of course, the biggest thing is that we've been a huge quarter. Since we last spoke, we were talking about where markets were going to go. We had DeepSeek come through, and then we had a couple of changes in the tariff front in the US. So can you speak to where markets are right now?
Look, I think we've gone through a period of, shock and awe from Donald Trump and the tariffs. And there was a period where, the Liberation Day tariffs on April 2, the markets concluded that if they go through as threatened, would probably cause a US recession, like the shock to the US from a big increase in import prices and just the uncertainty of what tariff levels will be could cause a recession. And now we've seen Donald Trump back away from those tariffs. Look, he hasn't removed them, he's postponed them, but I think the markets are starting to see through his threats. They think a lot of what he says is hot air effectively, and at the moment they've rebounded and priced out that risk of recession. So we've gone from soft landing celebration of the global economy at the start of the year, inflation coming down, central banks being able to cut interest rates, economic activity remaining resilient, so a fairly good outlook, to then fear of the tariffs and what that may do. And now maybe looking through those tariffs and saying Donald Trump, ultimately is not going to be crazy enough to cause a US recession and hopefully we'll back away in time. And even now, I think we're seeing on again, off again threats about tariffs, but the markets, really not reacting in the same way that they've done in the past. So it really comes down to, is he going to settle down on the tariff front or not, and on the view that he isn't crazy and he doesn't want to cause a recession, then hopefully things can settle down and markets can grind on from here.
Thank you. Last year we were talking about the US exceptionalism, the idea that you're going to get better returns from US equities over the medium and long term. And I'm curious to know what your thoughts are in the context of a potential recession in the US. There are lots of economists out there saying that it's a 50-50 chance of happening, and some also. Do you have a view on the likelihood of recession in the US and what that might mean for the concept of US exceptionalism?
Look, it cuts to, if there's a US recession, obviously equity markets take a tumble. They'll probably fall below the lows that we saw in early April.
Yes.
And all equity markets around the world generally follow. So if the US sneezes, we'll catch cold. So I think that's more of a cyclical question. And look, in fact, if it's a US recession and global equity markets fall, maybe it will be the US doesn't fall by as much. Other, less liquid markets, emerging markets, whatnot may fall by more. So that's more, the question about US exceptionalism just does come down to the dominance of the US tech sector.
Yes.
And whether or not the earnings that they've been able to generate in recent years can be sustained. And that, there are some question marks about are valuations in that area too high for what the earnings they are delivering? Will DeepSeek, as you point out, be a threat to their dominance in the AI area? If you can build AI models cheaper and don't need fancy chips, you don't need big data centers, then maybe, the position that we think the Mag 7 companies are in is under question. So those are more the questions, I think, in terms of the dominance, which is, more, structural questions rather than a cyclical question. Because, whether or not the US goes into recession, I don't think will challenge the Mag 7 dominance. It's really these other two questions and at the moment, the jury's still out on that. I mean, we're having that discussion about DeepSeek. I mean, no one's quite sure what threat it does pose because we're not, basically anything that comes out of China, you have to take with a grain of salt. They say they've developed these models, they're pretty good, and they've used less advanced chips, and they didn't need to use as much data processing. That may or may not be true. We're not sure. And I think end of the day, barring a US recession, if we don't get a US recession, my base case is we won't at this stage. I think Trump will back down. The Mag 7 are going to continue to be supported by investors until they start disappointing on the earnings front. And so far, at least, Q1 was another example where, generally speaking, they matched and beat expectations. And so we can worry about the future, but until it actually arrives, because there's so much uncertainty what that future will be, until that future appears in real time and starts to affect their earnings, as we saw with Tesla, for example. Tesla started to falter in terms of its supply deliveries and its profits, and then it did take a tumble. So I think the jury's still out, and I don't think yet it's premature to sort of call an end to US exceptionalism.
I think you might have answered my next question, which was around around valuations. We spoke before this about the idea that if we got to late 2024, early 2025, it really looked like, particularly US equities, that very, very high PEs broadly, and you could see that they were priced based on a really optimistic outlook. That language being priced for perfection, probably a little bit too strong, but certainly priced for optimism. And then since then, we firstly had DeepSeek, and we had the tariffs come through, and there's a conflicts in India, Pakistan, for example. That's an unknown thing, but it's never nice for two nuclear-armed countries to have conflict.
Nice.
In these scenarios, is all of the rebound justified? I suppose am I hearing you correctly? You're saying, well, as long as the earnings are still there, then that's where the share price should be.
Look, I think it's justified in the sense that markets are basically concluding that Trump is more hot air than reality, and he's not going to basically risk the US going into recession. If he needs to be, he's going to pull back on the tariff front. So basically what we saw in April was essentially pricing in the risk of US recession due to tariffs. Trump backing down has priced that risk out. And now, is the market, too highly valued? I mean, the US is trading at over 20 times earnings, but it's the Mag 7 companies are a big chunk of that. 25% of the market now in the US is dominated by a handful of large companies. And they are trading at high valuations because for the last 5 to 10 years, they've been generating strong, dependable, reliable earnings. Their business models, they're dominant in each of their relative business fields. And investors have just been rewarding that consistency, if you like, with a higher valuation. So it's hard, you got to. It's one thing to say the markets are highly valued, then what's the catalyst to cause that correction? I think markets don't correct in and of themselves because suddenly they wake up one day and say, Google's too highly valued.
Yes,
you need to see, as I said, goes back to my earlier report. You need to see some stumbles on the earnings front. And some competitive threat emerging for one or all of those companies. And at the moment, it's not happening. And so I think the markets are becoming comfortable with a 20 PE in the US. Assuming bond yields, again, the other risk that we haven't mentioned is US debt levels and what that does to bond yields. At the moment, the US bond yields are around a 10-year bond yields about 4.5%. Which is sort of okay, but if they were to suddenly go up over 5%, for example, then I think the high valuation in the US would be under pressure. But that would lead to what I think is a valuation correction. You might get a 15, 20% correction in the markets just to bring PE ratios back down again without a recession. But that's just because the markets are readjusting to the higher yields. Now, if you do get a recession, you get another thing happening. You get earnings collapsing. And then you get markets not only just adjusting the value back to a fairer level, but fear taking over from greed, and the valuations go to a very cheap level. So that's what turns a correction into a deep bear market. But at this stage, as I said, it comes back to Trump and tariffs. And if you think he will pull back and avoid a recession, then and bond yields don't go up because of the debt concerns, then I think that the PE valuations can sort of hold where they are. And meanwhile, earnings growth, which is still bullish in the US, can continue to drive earnings higher over the next 6 months to a year.
Lastly, when we spoke previously, we were talking about interest rates and talking about what they might look like in 2025. Your prediction's been pretty spot on so far. You were saying that you thought there'd be a couple of interest rates in the early half of the year, and then we'll see what happens thereafter.
Yeah.
And that's materialised now. What does that mean for the Australian market, perhaps from an equity perspective, and then also thinking about the obvious big asset that a lot of Australians think about, which is property?
Yeah, so the RBA's cap rates twice already. Basically, on confirmation of inflation coming back toward the target band. So just an update there, the underlying measure of inflation, the trim mean as we call it, went from 3.2 in the December quarter to 2.9 in the March quarter, which is good enough for the RBA to cut rates again in May. Their forecast, and I agree with it, is that underlying inflation will continue to edge lower, so that by the June quarter report, which will get in late July, it could come down to 2.6%, 2.9 and 2.6, which is close to the middle of the band, in which case the RBA can continue to what we call re-normalise rates, bring them back to a more normal level. At the moment, the cash rate is 3.85%. It's above normal. It's considered restrictive. Normal is closer to 3%. So basically, my outlook is that as the inflation numbers come out and confirm a decline in inflation back to the midpoint, they can continue to re-normalise rates. And my base case at the moment is at least 2 more rate cuts this year following the next 2 quarterly CPI results. So we get the June quarter one in late July, which means they can move in August, and we get the September quarter in late October, means they can move in November. If we get an emergency, if the US does go in a recession or something like that, they can cut by more. But barring even a recession in the US, I think the inflation numbers should be good enough to get rates getting back to normal. The Fed could be cutting rates also in the US. The only complication is they're worried about the inflationary impact of the tariffs. Their hands are a little more tied in the short run. But if we get through the tariff issues, and maybe there's a short run hit to inflation in the US, like we have a few monthly numbers which are high because of the tariffs, but then they drop back down again, and we're done with the tariffs, then I think the Fed can refocus on the underlying trend of inflation and maybe also cut rates later this year. Now, what does that mean for the Australian market? I mean, our market, basically I think about our property market as supply constrained, and so the prices, the average price of a property, particularly in Sydney, Melbourne, is what the average household can afford to pay, given the current level of income and interest rates, and we'll pay up to that amount because of the supply constraints that we have. So as the RBA cuts rates, all of a sudden people can afford to pay more for a property, they can borrow more, and unfortunately it will lead to, fortunately or unfortunately, depending on the situation, lead to a rebound in house prices. So a lot of the affordability gains from lower interest rates will be quickly eaten up by house prices moving higher. So, not a boom, but certainly I think we're seeing signs of a turnaround in the property market on the back of the RBA rate cuts.
Mm-hmm. Mate, what a perfect answer, and thank you so much. It's always a pleasure to come in and learn more about your point of view. And so far, you've done pretty well in terms of your predictions. So thank you again, David Bassanese from BetaShares, mate. A real pleasure to chat to you.
Good to do this.